You know, after all my years watching price crawl up and slide back down, I came to one plain, stubborn truth that most traders don't want to hear. The market doesn't punish you for being wrong. It punishes you for being early. That one idea, more than any fancy indicator or clever formula, fixes most bad entries. And when I say most, I mean the kind that drains your account one small loss at a time, the kind that makes you wonder if you've lost your touch. Have you ever been right about a stock, but still lost money on it? Of course you have. We all have. And that's the quiet crime of bad entries. Back in my day, I learned to sit and watch, sometimes for weeks, waiting for a stock to show its hand. I wasn't trying to guess. I was waiting to see. There's a big difference, and if you don't respect it, the market will teach it to you in a very expensive way. Most bad entries come from trying to be clever instead of being patient. You see a chart that looks ready. You feel the itch in your fingers, and you tell yourself, if I just get in now, I'll catch the whole move. But tell me, when has that urge ever treated you kindly? What fixes that is simple, even if it isn't easy? You wait for the market to prove you right before you put your money down. A stock that is truly ready to rise will show strength. It won't whisper, it will speak up. It will push through old highs, it will hold its gains, and it will refuse to go down when the rest of the market is weak. When you learn to enter only after that kind of proof, you cut out most of the bad trades before they ever get a chance to hurt you. Doesn't it make sense to let the market do the talking instead of your hopes? I used to say that it was never my thinking that made the big money for me. It was my sitting, and sitting is what keeps you out of trouble. When you buy a stock just because it looks cheap, or because it has fallen a long way, you're stepping in front of a train and hoping it will slow down for you. Sometimes it does, but usually it doesn't. Price doesn't care about what you think is cheap. It only cares about whether buyers are stronger than sellers right now. And if the buyers haven't shown up yet, why are you in such a hurry to hand over your cash? This is where the charts come in, not as magic, but as a simple record of what traders are actually doing. A good entry is just a point where the crowd has already begun to move in the same direction. You're not leading the parade, you're joining it. When a stock breaks out of a long range on heavy trading and holds above that old ceiling, that's the market saying, we're ready. Compare that to buying in the middle of a slump, just because you think it has fallen far enough. One is evidence, the other is opinion. Which one do you think deserves your money? Now I know what you're thinking. But if I wait for confirmation, won't I miss part of the move? Yes, you will. And that's the price you pay for safety. The first part of any move is the most dangerous part. It's where false starts live, where breakouts fail, and where most traders get shaken out. By letting that first piece go, you buy yourself something far more valuable than a few extra points. You buy yourself clarity, and clarity is what keeps your account alive over the long run. Bad entries are not just technical mistakes. They are mental ones. They come from impatience, from fear of missing out, from wanting to be in the market all the time. But the market does not pay you for activity. It pays you for being right and being disciplined. Every time you chase a move that hasn't proven itself, you are telling the market that your feelings matter more than its facts. How often has that worked out for you? I've seen traders blow up not because they were fools, but because they were always in a hurry. They wanted to be first, they wanted to be smart, they wanted to outguess the tape. But the tape doesn't need to be guessed, it needs to be listened to. When a stock is ready, it will move with or without you. Your job is not to start the move. Your job is to recognize it and step aboard once it is already underway. That one shift in thinking fixes more bad entries than any rule book ever could. Think about your last losing trade. Was it really the stock's fault, or did you jump in before the buyers had taken control? Did you buy because the chart showed strength, or because you felt it should go up? Those two reasons look similar on the surface, but they come from completely different places. One comes from evidence, the other comes from ego. And the market has a way of humbling ego faster than anything else on earth. When Wealth in trading is built the same way trends are built, one steady step at a time. You don't get there by swinging at every pitch. You get there by waiting for the ones right over the plate. When you clean up your entries, you clean up your whole business. Your stops get smaller, your confidence gets steadier, and your account stops bleeding from 1,000 little cuts. Isn't that what you really want? Not excitement, but consistency. Strong breakouts matter more than cheap prices, and that idea goes straight to the heart of why so many traders struggle. A stock can look like a bargain all day long, sitting there beaten down, trading far below where it once was, but that low price does not mean it is ready to go up. Price only tells you where it has been, not where it is about to go. What tells you where it is going is strength, and strength shows up in breakouts. That's when buyers finally overwhelm sellers and push price into new territory. Without that push, you are just buying something that is still falling or at best drifting sideways, and that's a slow way to bleed capital, even if you don't notice it at first. A breakout is not just a line on a chart. It is a change in behavior. It is the moment when a stock stops respecting old resistance and starts acting like it has somewhere higher to go. Before that moment, every rally gets sold into. After that moment, those sellers are either gone or forced to buy back in. That shift is what creates sustained moves, not the fact that a stock looks cheap compared to last year's highs. Cheap is a story, but a breakout is a fact written right there in the price. Most traders are trained, or maybe conditioned, to look for bargains. They walk into the market the same way they walk into a store, hunting for something on sale. But markets don't work like stores. A stock that is down 50% is not half off. It is simply a stock that has lost half its value, and usually for a reason. Until buyers show they are willing to pay higher prices, that reason still matters. A strong breakout is proof that something has changed, and that proof is worth far more than any discount you think you see. When a stock breaks out, it is telling you that demand is stronger than supply. That might sound simple, but it is the whole game. Prices only move up when more people want to buy than want to sell. A breakout shows you that imbalance in real time. You don't have to guess at it. You don't have to read a report or listen to a story. You can see it right there on the chart as price pushes into new highs and stays there instead of falling back. That staying power is what separates real breakouts from false ones. False breakouts do happen, of course, but even they give you more information than buying something just because it looks cheap. When you buy a breakout and it fails, you usually know quickly. The stock drops back below the old resistance, and you can step aside with a small loss. When you buy something that is cheap and still weak, you can be wrong for a long time without knowing it. The stock just keeps drifting lower or going nowhere, tying up your money and your attention while better opportunities pass you by. There is also a psychological edge to trading strong breakouts. When you buy strength, you are going with the crowd instead of against it. Other traders, funds, and algorithms are all seeing the same move, and many of them are acting on it. That creates momentum, and momentum is a powerful force in markets. When you buy something that is cheap and weak, you are often alone. You are hoping other people will come in later and push the price up for you. With a breakout, those people are already there. This is why strong stocks tend to get stronger. Once a stock proves it can break into new ground, it attracts attention. More traders notice it, more capital flows in. That demand can feed on itself for a while, creating trends that last far longer than anyone expects. Cheap stocks, on the other hand, often stay cheap because there is no new demand to change the situation. They can sit at the bottom for months or even years, and all the while your money is doing nothing. Strong breakouts also make risk management easier. When you enter a trade after a stock has broken above resistance, you have a clear line in the sand. If price falls back below that level, the breakout has failed and you can exit. That keeps your losses small and defined. When you buy something just because it looks cheap, where do you get out? There is no obvious level that tells you your idea is wrong, so you either hold and hope or you panic at the worst possible time. The idea that cheap prices are better is deeply rooted, But it comes from the world of value investing, not from trading trends. In trading, you are not trying to own a piece of a company for 10 years. You are trying to ride a move that is happening right now. For that, you need evidence of strength. A breakout gives you that evidence. It shows you that the market has decided this stock is worth more today than it was yesterday, and that decision is being backed by real money. There is also the issue of opportunity cost. Every dollar you put into a weak, cheap stock is a dollar you cannot put into a strong, breaking out one. Over time, that choice matters more than most traders realize. Strong stocks tend to move faster and farther. Weak stocks tend to crawl or sink. Even if you are right about both, the one with strength will usually make you more money in less time. And time is a resource just like capital. Waiting is a trading edge, not a weakness, and that idea runs against almost everything people are taught when they first come into the market. From the outside, trading looks like action. Screens flashing, orders going in, positions opening and closing. So a new trader thinks the way to make money is to be busy, to always be in something, to always be doing something. But the truth you only learn after losing enough money is that activity is not the same as progress. Most of the time, it is just expensive noise. When you wait, you are not being lazy. You are gathering information. Every candle that forms, every test of support or resistance, every push and pull between buyers and sellers adds a little more clarity to the picture. If you jump in too early, you are trading in fog. If you wait, the fog lifts. Patterns become clearer. Real strength separates itself from temporary bounces. That extra clarity is what gives you an edge, because you are no longer guessing, you are responding. Markets move in cycles of contraction and expansion. There are long stretches where price goes nowhere, churning back and forth, wearing out anyone who tries to trade every small wiggle. Then there are bursts of movement where trends form and money is actually made. Waiting keeps you out of the choppy, dangerous parts and leaves your capital free for when the market starts to run. Without waiting, you end up stuck in trades that go nowhere, missing the real moves because your money is tied up. There is also a deep psychological benefit to waiting. When you are not in a trade, you can think clearly. You can look at charts without emotional attachment. You can see what is actually happening instead of what you hope will happen. Once you have money on the line, every tick feels personal. Your mind starts looking for reasons to stay in, to justify the position, even when the market is telling you to get out. Waiting keeps your mind neutral, and neutrality is one of the most valuable things a trader can have. A lot of bad trades come from the simple discomfort of being on the sidelines. People feel like they are missing out, like opportunities are slipping through their fingers. But most of what they think are opportunities are just random movements that lead nowhere. Waiting filters those out. It forces you to be selective. It makes you ask, is this really worth risking my capital, or am I just bored? That question alone can save you more money than any indicator. When you wait for the right moment, you also get better entries. You are not chasing price. You are not trying to predict. You are stepping in when the market has already shown its hand. That usually means tighter stops and better reward. To risk. You might take fewer trades, but the ones you take have a higher chance of working. Over time, the difference compounds in a way that is hard to appreciate until you see it in your own account. Waiting also aligns you with the natural rhythm of the market. Big moves don't happen every day. They build up, they pause, they test, and then they go. If you are constantly trading, you are often fighting that rhythm. You are trying to force profits out of periods that are not meant to produce them. Waiting lets you sync up with the market instead of pushing against it. There is a kind of quiet confidence that comes from waiting. You stop feeling like you have to prove something on every trade. You know that another opportunity will come, because it always does. That confidence keeps you from overtrading, which is one of the fastest ways to drain an account. Overtrading is just impatience wearing a disguise, and waiting is how you take that disguise off. Some of the best trades are obvious in hindsight, but they only look obvious because someone had the patience to let them set up. A stock breaks out of a long base, pulls back gently, and then starts moving again. That whole process can take weeks. If you are in a hurry, you will either jump in too early and get shaken out, or you will be stuck in something else when the real move begins. Waiting puts you in position to take advantage of those moments instead of watching them pass by. Waiting also makes losses easier to handle. When you take a trade that you waited for, you have a clear reason for being in it. You know what you are looking for and where you are wrong. If it fails, it feels like a normal part of the process, not a personal mistake. When you take impulsive trades, every loss feels heavier because deep down you know you didn't really have a good reason to be in the trade in the first place. Over time, waiting builds discipline, and discipline is the backbone of any trading career. It is easy to be disciplined when things are going well. It is much harder when the market is slow and you are tempted to manufacture opportunities. Waiting through those slow periods is what keeps your edge intact. It preserves your capital and your mental energy for when the market actually gives you something worth taking. The market does not reward you for how hard you try. It rewards you for how well you time your risk. Waiting is how you improve that timing. It gives you better context, better entries, and better exits. It turns trading from a frantic chase into a deliberate process. And that shift from chasing to waiting is often what separates those who survive from those who burn out. You also start to notice that the best traders are often the quietest. They are not constantly in and out of positions. They are not glued to every tick. They are watching, waiting, and acting only when the odds are clearly in their favor. That calm approach is not boredom. It is focus. It is respect for the fact that the market decides when opportunities appear, not you. Late entries beat early guesses, and that single idea can save a trader from more pain than most people realize. The market is not a place that rewards bravery or clever predictions. It is a place that rewards timing and alignment with what is actually happening. When you enter too early, you are not trading the market. You are trading your opinion about what the market should do. When you enter later, after the move has already started, you are trading what the market is actually doing, and those are two very different games. An early guess feels exciting. You see a stock near support, or sitting at the bottom of a range, and you tell yourself that the downside is limited and the upside could be big. That idea is seductive because it makes you feel smart, like you are getting in before everyone else. But in reality, all you are doing is stepping into uncertainty. The stock has not proven anything yet. It could bounce, but it could also keep falling, and there is nothing in the price to tell you which one will happen. You are just hoping. A late entry, by contrast, comes with proof. The stock has already moved. It has already broken out, held above a key level, or started to trend. That movement tells you that other traders and investors are committing real money to it. You are not alone. You are joining a flow that is already going somewhere. Even though you might pay a higher price, you are paying for confirmation, and that confirmation is what keeps you out of a lot of bad trades. People worry about buying late because they are afraid of buying the top. That fear makes sense, but it often keeps them from making any money at all. The truth is that most big moves do not end the moment they begin. They unfold over time, with pullbacks and pauses along the way. By waiting for a move to start, you are not buying the end, you are buying the middle, which is where the bulk of the profit usually lies. When you guess early, you also make it harder to manage risk. There is no clear point that tells you that your idea is wrong, because the stock has not done anything yet. It is just sitting there, and you are projecting a future onto it. If it drifts lower, you may tell yourself it is just noise. If it drifts sideways, you may keep waiting. Before you know it, a small mistake has turned into a big one. Late entries give you structure. There is a level that was just broken, a trend that has just begun, and if those things fail, you know it is time to step aside. Late entries also help with discipline. When you decide to wait for confirmation, you automatically reduce the number of trades you take. You stop trying to predict every turn and start focusing on the ones that are actually happening. That selectivity improves your overall performance. because you are no longer scattering your capital across a bunch of uncertain ideas. You are concentrating it in places where the odds are better. There is a mindset shift that comes with embracing late entries. You stop thinking of yourself as a hunter trying to catch the first move, and you start thinking of yourself as a follower of trends. That might sound less glamorous, but it is far more profitable. Trends are what create wealth in trading, not isolated guesses. By entering after a trend has started, you put yourself in position to benefit from its continuation rather than its uncertain birth. Another advantage of late entries is emotional. When you buy into strength, it is easier to hold. The price is already moving in your favor, which reinforces your confidence. When you buy early, you often have to sit through drawdowns and doubt before anything good happens. That stress can push you to exit at the worst possible time, right before the move you were hoping for finally begins. Late entries also align better with how large players operate. Big funds and institutions cannot quietly build positions at the very bottom. They need liquidity, and that liquidity appears when a stock starts to move and attract attention. By waiting for that movement, you are essentially riding along with bigger, more informed players. Early guesses often put you on the opposite side of them, trying to catch falling knives while they wait for confirmation just like you should. The idea that you have to be first is deeply rooted in human nature. We like to think that getting in early gives us an advantage. In trading, it usually gives us risk. Being right too soon is the same as being wrong, because the market can stay against you longer than you can stay solvent. Being a little late, on the other hand, means the market is already agreeing with you, and that agreement is what makes trades work. Over time, you will notice that many of your best trades would have been fine even if you entered later. You might not have caught the exact bottom, but you would have caught the bulk of the move. Many of your worst trades, on the other hand, would have been avoided entirely if you had just waited for a little more confirmation. That difference, multiplied over dozens or hundreds of trades, is what separates profitable traders from the rest. Late entries also encourage patience, and patience is a powerful tool in markets. When you are willing to wait, you are not desperate for every setup to work. You can let mediocre opportunities go and focus on the ones that really stand out. That patience keeps you aligned with quality instead of quantity. There is also a practical side to this. Markets are full of false starts. Breakouts that fail, reversals that fizzle, patterns that look perfect and then collapse. If you jump in at the first hint of a move, you will be caught in many of those traps. If you wait for the move to actually prove itself, a lot of those traps disappear. You may still have losses, but they will tend to be smaller and less frequent. Confirmation protects the account in a way that nothing else really does, because it forces you to trade what is happening instead of what you hope will happen. In the market, hope is expensive. It leads you into positions that have no real support, no real demand, and no real reason to move in your favor other than your own belief. Confirmation, on the other hand, is the market showing you that buyers or sellers are actually stepping in with conviction. That difference may seem small, but over time it is the difference between survival and ruin. When you wait for confirmation, you are letting price and volume tell you a story. You are not inventing one. A stock that breaks above resistance and holds there is telling you that sellers at that level have been absorbed. A stock that pulls back and then finds support is telling you that buyers are willing to defend their positions. These are not opinions. They are observable facts, and facts are much safer to trade than theories. Without confirmation, every trade is a gamble. You might have a good reason, a pattern you like, or a feeling about where the stock should go, but none of that matters if the market does not agree. The market does not owe you anything. It does not care how convincing your analysis is. It only moves when enough people are willing to commit money in the same direction. Confirmation is how you see that commitment. One of the most common mistakes traders make is trying to anticipate confirmation instead of waiting for it. They see a stock approaching a key level, and they jump in, thinking they will be early. Sometimes it works, but often it doesn't. The stock hits that level and reverses, because the buyers they were counting on never showed up. If they had waited for the level to actually break, they would have avoided the trade altogether. That one small act of patience can save countless small losses that add up over time. A confirmation also gives you a framework for managing risk. When you enter after a breakout, a support hold, or some other clear signal, you have a reference point. If price falls back below that level, you know the idea is no longer valid. That lets you exit quickly and keep losses under control. Without confirmation, there is no such reference. You are left guessing how much pain is too much, and that usually leads to either cutting winners short or holding losers too long. There is a financial discipline that grows out of waiting for confirmation. You stop throwing money at every setup that looks interesting. You start demanding that the market meet your standards before you risk your capital. That discipline keeps your account healthier because you are no longer bleeding from dozens of small, unnecessary trades. You are choosing your spots carefully, which is how any business should be run. Confirmation also changes how you feel about your trades. When you enter with confirmation, you have something solid to lean on. You know why you are in the trade, and you know what needs to happen for it to work. That clarity reduces anxiety. When you enter without confirmation, every tick against you feels threatening, because deep down you know you are not standing on firm ground. Over time, this difference shows up in your results. Traders who rely on confirmation tend to have fewer trades, but a higher percentage of them work. Their equity curves are smoother. Their drawdowns are smaller. They stay in the game longer. Traders who ignore confirmation tend to be in and out constantly, riding emotional swings, with accounts that look like a saw blade. The market is full of noise. Prices wiggle for all sorts of reasons that have nothing to do with real supply and demand. News headlines, rumors, short-term speculation, algorithmic trading, all of it creates movement that can trick you into thinking something meaningful is happening when it isn't. Confirmation filters out a lot of that noise. It waits for the movement to be strong enough and sustained enough to matter. There is also a deeper money mindset at work here. When you demand confirmation, you are treating your capital with respect. You are saying that it will only be put at risk when the odds are in your favor. That attitude is what separates traders who last from those who flame out. It turns trading from a game of chance into a process of probability.